All right. Thank you for tuning in. We are doing a short little presentation on the election that's coming up here soon. But this is to introduce a new format to how we've been doing this in the past. Before we're doing a longer form webinar with questions and answers that took about an hour. We've had some feedback from our viewers, and it's a little cumbersome to get through an hour-long video. So what we decided to do is try something new, and this is our maiden voyage. So we're going to be more focused on one or two subjects and keep a video presentation down to maybe 10 or 15 minutes, so it's a little more digestible and doesn't consume so much time on the viewer's part, on your part. But thank you for coming, and we're excited to talk about the election that's coming up here soon. So when we go to the next slide real quick. So as we've been talking to clients over the last couple of months, we get this pretty frequent question in this time of year, about every 4 years, not about, but every 4 years, we get this question is, how will the election affect the markets? I understand it's a concerning question, especially in the last couple of election cycles for president. They've been pretty contentious, volatile. We have a very kind of a divided democracy right now, and it causes lots of concerns. But history kind of teaches us some interesting lessons in all this that we hope you find it interesting too. So let's go to the next slide, Mark, real quick. So what we're talking about is, how does the presidential election affect markets? We're kind of looking at the lead up and the aftermath kind of right after. And this chart here kind of explains, or kind of gives us a little historical view of what's gone on in the past. So if we look at the, sorry, I just lost some, at the gray line. So this gray line here.
So this right here.
Yeah,
I'll be your little
Vanna
White here.
Which is funny. So the gray line is of the last 5 years. The black line right next to it is the last 10 years. And the blue line is this actual election year, and the red line is the S&P 500. So as we see when we're looking at this, as we kind of approach November, markets kind of take a little downturn. It's evident in the last 5 and 10 year cycles, and also in this current year cycle. And then we get a little volatility up to and through the election. And then about not shortly after the election, markets kind of tend to go up and increase. And that's been the repeated cycle every 4 years, no matter who's being elected, Democrat or Republican, or, we haven't had an independent, so we won't mention them. So anyways, this is what the history has taught us as far as how the S&P and 500 is reacting. If you look at that red line, we're a little bit further along. This is maybe a little anomalous, but that red line's kind of continued to go up. But if someone asked me now, hey Dan, what do you expect to happen? I might just say, I'll probably expect a little bit of volatility until after the election. After election being maybe beginning of December, or a week into December kind of time frame. Mark, is there anything more you want to add to this?
Yeah, I mean, I think typically, we've talked about this in the past, but markets, in this case, the stock market, we'll call it the S&P 500 right now, doesn't necessarily like uncertainty. So when there's more uncertainty, you're going to see more volatility. My standard answer, because I've been getting this question over the last couple of months, is I don't know what's going to happen. I hate to say that. I wish I had a crystal ball, but I don't. I would presume that markets might think in the short term that if there's a Republican office, that there might be lower regulation, lower taxes, so on and so forth. So that might be viewed as better for the markets. And if the opposite, Democrats in office, maybe the opposite. But the data doesn't show that. It doesn't show it at all. I think what this is showing right here is uncertainty. Markets don't like uncertainty, so it's kind of working it out. And then right after the election, you might have a drop, or it might go up. And then, but after the hoo-ha of the election, and granted, we're not talking about contentious elections like we've had in the last 4 years, but then markets recover and we get back to normal returns, which is basically markets go up, stock market goes up 75% of the time. So it's not surprising that we see this line here after the election. So
Next slide.
yeah, to put it another way, this is a chart that goes back. This is S&P 500 returns going back to 1926 through the end of last year. And, I guess I would poll the audience, even though they're not live on this one, is can you see a correlation here? Is it better to be a Republican in office or a Democrat in office? And as I look at this, I can't see the difference other than the fact that there were some bad times. Well, let me put this another way in this next chart. So this is overall average stock annual returns during presidential terms. Okay, whether that's 4 years or 8 years. Here's the 0%, 10%, 30, 50, and then the opposite down. And basically what you can see is there's really only been 3 presidencies in the last, since 1929 that had negative returns over their term. And the biggest being Herbert Hoover, which was the Great Depression. And so that's why that number is extremely negative. But overall, again, if you look at the blue, the Democrats, Republicans, it's very difficult, if not impossible, to see any direct correlations to who's in office, even though people think that I do think this is a generalization, but I think it's more right than wrong, is people think that Republicans, the market does better when Republicans. It's just not true. So
Right. Go back to that previous slide real quick. Just a couple of things that occurred to me looking at this, and I think you mentioned this before, was that if you ignore the negative years, all the positive years are almost 50-50. I mean, it's a coin flip as to whether who does better. And it's very close. But the other thing that struck me at this is, as I thought about this, is that a 4-year presidential term is almost long enough for a complete market cycle. That is a cycle that goes up and down. Okay, that'd be a complete market cycle and back up again. Sorry, that's a complete market cycle. And typically those are measured in 5-year increments. So it's not surprising that you see a lot of these, especially presidents who have like a 2-term presidency, that their returns are positive, because that's almost 2 full market cycles. So it's not surprising that you would have positive returns over that period of time.
Yeah, the only one that got the bad draw was, well, not the only one, is Herbert Hoover. The Nixon, but George Bush had 2 terms with 2 of the nastiest stock market declines in that 8-year term, the dot-com bubble and bust, and then also the Great Recession. And so, but I think that's a really good point. Let's go to the next slide. You want to cover this one, Dan?
No, why don't you go ahead?
Okay. So a lot of numbers here, but basically what this is showing is returns the first year of a presidency, the second year, the year right before the election year, and then the election year. Okay. A lot of busy numbers here, but this is the bottom line: is the best year is always, not always, but historically is the year leading up to a presidential election. You can see the average return has been 14%. The worst year is the second year of a term. And Dan and I were kind of talking through, well, why is that? And it could be because that's when they're getting their landmark legislation through. And there could be, a lot of, gridlock, depending on if there's congressional, a divided government. But, so basically, if you look at the election year, and this is, it averages about the same as the first year. So some people, they have kind of, this is going back to the beginning of the year. Is this going to be a bad year because the presidential election? And typically the data hasn't shown that. And also, again, I have to caveat, this is Mark and his chart craziness, but I just want to point out a couple things on this one. Okay. This top area right here is what the real economy, the real GDP, and that's kind of GDP taking into account inflation. If you net inflation out, and then the bottom is the S&P 500 returns. So this is more just to kind of illustrate that there is really no correlation. Now, if you look at the S&P 500 returns, it shows that the Republicans actually had better returns at 12.9% average. And this is if they had control of the entire government. Okay. But I have to point out this has only happened 10% of the time. So that's not even a data set that's really statistically reliable, right? Because if you look here, and we've talked about this in the past as well, is that the economy and stock market returns are not always correlated. I mean, they're not directly correlated, because you can see the Republicans, even though they had the highest returns, 13%, the GDP was much lower than the Democrats. Okay. But what we usually are facing is a divided government. And so this is kind of the returns that we have here. And that could very well happen again in this next election. So the bottom line on this chart is the data just doesn't show that it makes a big difference.
Yeah, the one party is not better than the other. We thrive more on a divided government where cooperation or working together works better. Anyways.
Exactly. So, okay, next chart, Dan. That's all you.
So this is kind of a little, if you kind of look in the microscope of what we were talking about just in the last couple of slides before that, where this is a slide of looking at the energy sector, which is the dark line on the bottom, and the clean energy sector, which is the green line on the top side, where during the Trump administration, his last term, the clean energy returns were just kind of started to kind of skyrocket, which is kind of you wouldn't have thought that during Trump, because he was the pro coal guy, and you would think that the other typical energy sector would do a lot better, when in fact during his term they kind of declined a little bit. And then as you look at Biden, it's just the opposite. Democrats are more associated with clean energy and then incentivizing that and the growth of that sector. But during Biden, it was kind of on a decline. And then the normal energy sector, or the broad energy sector, was on an upswing. And as we kind of look at this, I start questioning and asking, well, is it because of the current administration, or is some of the upswing in Trump could be an effect of Obama's term, where he had a lot of incentives for clean energy to get that kick started, and maybe that just kind of took hold and started to grow, and maybe it just kind of matured out, or maybe by the time Trump comes into a term and does his changes and gets his policies in place, where it's less favorable in the following 4 years. So you're just kind of, it's hard to tell who's really responsible for this kind of performance or returns that some of these sectors have on an individual basis.
It also depends, from a presidency standpoint, is, they do control policy if they can get it through Congress. They can do their executive orders and such. But really, the bigger factor is the normal market cycle, economic cycle, which could be 5, 6, 7, 8 years long. And depending on when you enter office or exit office, that's going to, more than likely have a bigger effect than any policy changes that they're going to have.
Yeah. Yes.
So
go to the next slide.
Okay, Dan, good luck on this slide. Yeah.
Okay.
He drew the short straw, by the
way. Yeah, I drew the short straw on this one. So up until now, we've kind of been looking at a kind of a very myopic frame of mind here. We're kind of looking at what happens during an election, or right before, or right after, or during a 4-year period. In the larger sense, that's a very myopic kind of look. So this is kind of takes a bit of a longer view, and there's a couple of 3 things I just want to kind of point it out. So in the upper left part of this chart here, that left side of that chart right there, that's the spending. That's 2024 total spending plan that they're going to do, and how they're going to spend. You know, the bottom gray part is Medicare and Medicaid, got spending in Social Security, defense, and all that. The right side of that is the sources of financing or sources of income to pay for that. That's not what's on the left. And what we see there that, the bottom one is income tax, corporate tax, Social Security tax, and there's a bunch of other stuff. But that top little dotted line, this is the concerning part. It's a giant deficit. So there's not enough tax revenue coming in to pay for all the spending. And this is not a 2024 issue, but this has been a long-term issue where if you kind of look down in that lower right chart, when Clinton left office, he had actually a surplus. So around 2000
Right here.
we had an explosion of spending. And it didn't matter whether it was Bush or Obama or Trump or Biden, spending just kind of exploded. Now, of course, we've had several wars. We've had a couple financial crises. I'm not saying there wasn't reasons for some overextended spending, but right now the kind of the spending valve is wide open, and it's been wide open for a long time. And so the total deficit has just kind of been climbing, climbing, and climbing. And this is the long-term look. That has a very kind of a long tail effect on things going forward. And if you look at that lower left box down here, right here. So just focus on that real GDP top line there. So going forward, this additional debt and the servicing of the debt, if we don't get control of that and somehow figure out how to either reduce it or pay it off or grow the economy faster than we anticipate, the real effect is a slower GDP, which is essentially could be negative for everybody. Could be more unemployment going forward. Could lead to depreciation, which is a real hard thing to kind of correct and that kind of thing. But it's kind of could suppress returns, revenues for companies, that kind of thing. If we have a slower market going forward, we need when you have a very large debt like this, you either need a very super strong economy and growth in your GDP to make that debt look smaller or make it smaller, or you're going to need higher taxes. So, the way out is going to be tough. Whoever decides to, Republican, Democrat, whoever decides to get a handle on this, and hopefully both of those parties start to look at this very seriously, because this is the long-term overhanging issue. It's not whether the president's a Republican or a Democrat. This is the problem, and it'll take both sides to solve it. Yeah.
Yeah, and just to point out a couple, one other thing. So this $2 trillion deficit, if you look at this line right here, this is now the interest that the government is paying on the debt. So it's half of that. And that's not going to go away until they start paying down the debt. And so, the economy, there could be some wonderful things in AI and biotech and, healthcare that leads to new sources of growth in the economy. Yeah. But also what leads to growth is more bodies in the United States and more people participating in the economy. So it's there's no wonder they're kicking the can down the street, because it's not politically I can imagine kind of political suicide if you address it head on during an election year.
Right.
You can do it after the election, but anyway, that's a big problem.
If you bang this drum too loudly or too often, you're shorting your political career.
Yep. And Dan and I were talking about this before we went on here. And this is another reason why the economy and stock returns are not exactly directly correlated, because you have to remember this is the economy, okay? But also companies, their primary objective is to increase shareholder value, which is code for increasing profits. And so there are various ways for companies to increase profits. They can lay off people, they can make certain investments, and so
they're very good at it.
They're very, very good at this and very ruthless. So don't take this slide as, oh my God, the stock market's going to take a dump right overnight.
Great point.
It's going to
Yeah.
take a while to sort through this stuff.
Yeah, even when the outlook seems kind of grim or down, there are opportunities for making money as well.
Yep, exactly. Okay. All right. Good job on that, Dan.
Thanks.
Okay.
Okay. So after that kind of bummer slide, we want to kind of end on a little bit higher note. Like, so what should we do with all this stuff? Well, this slide kind of paints the picture for you. So if you look at the little left side, so if you invested in the stock market only during a Republican presidency and invested $10,000, you know, you would grow your money. I mean, you did pretty good return, $300,000. Your 10,000 returned to 300. If you only invested during the Democratic presidents, you did a little better, got 1.2. But the smart money is, don't make these wild swings and bets. Stay invested, be reasonable, rebalance, you know, don't take more risk than you need. And, you know, your $10,000 over the last 70 years would be $37 million, which I don't know.
I'd take that.
Yeah, I'd take that. You could weather a lot of downturns, a lot of grim stories with $37 million in your pocket, I suppose. That's the end of that story. So again, I think people have heard this from us during good markets and bad markets. You know, our emotions kind of take a hold of us during up markets. We get greedy, and during down markets we get afraid. But the real best strategy is to kind of stay invested, be reasonable, rebalance, don't overextend, and we can weather the bad and rise on the good. So that's the moral of the story here.
Yep. And
I
that
think
is
that's
it. I think we went over 10 minutes. Maybe that was like 16 minutes, but please do give us feedback on if you like these shorter videos, and if there's any topics specifically that you would like us to address, please reach out to us and let us know, because that's why we do these things. So with that said,
we do enjoy doing this too, actually.
Yeah. Any parting words, Dan?
No, I think go out and vote, and or you know, do your civic duty.
Exactly.
This is our part of upholding our democracy.
Exactly. So okay. Well, thank you, Dan. Appreciate it.
Thank you.
And you all have a great day. Take care.
Bye-bye.